V12 for many years, and that's been part of our growth. The integration was very seamless, very straightforward. What's very important in our business is average order value. The higher that average order value is, especially in stores, V12 is a very important partner for us.
We want to grow with partners rather than sort of plug-ins, if you like. We want to be with people long term. The support from V12 has been amazing. The integration was seamless, and that's reflected in the results we've seen over the past months. I think they really understand our needs and wants and work with us to make things better for us as well as them. In my eyes, they're the perfect partner to go with long term.
When talking about the most important principles to the business and to me on the ground doing the deals, I think it's really, really straightforward. Very low execution risk and deliverability. And I think over the last 4 years, Secure Trust Bank has delivered on a constant and consistent basis in that respect. When they say they're going to do something, they do. From the very beginning, it was obvious that there was a meeting of minds and a real desire to create something flexible, something bespoke, something commercial.
Normally when we're looking to partner with a lender, speed, flexibility and sort of good working relationship is really important to us. And that's largely the reason why we've worked with Secure Trust for so long, because we have all those three things in abundance. What we really appreciate about the team here at Secure Trust is they grasp things extremely quickly, and ultimately that comes from experience. The team have got a fantastic track record of supporting us and our competitors in really what are the most complex transactions out there.
Welcome. Great to have you all at Investec and online today. Just to briefly introduce myself, I'm Ian Corfield, I'm the CEO. I joined the business in the middle of last year, and despite my youthful looks, I've actually spent 25 years in financial services, predominantly in retail and business banking in 3 different countries. And I'm glad to be here. Now, we're going to spell out a number of things across the course of today, but I guess the key thing for us is why we believe Secure Trust Bank is a strong and investable proposition. There are 5 key reasons behind that. Firstly, we're now lending into 2 scale addressable markets where we've got a strong track record and loads of market share headroom to grow into. Secondly, we'll talk about it more later on, but our investment behind simplification and efficiency in the business is going to drive us to a cost to income ratio that's in line with our sector leaders of 35 to 40%. The business is already, as we'll show, on a trajectory to deliver 16% plus return on average equity, driven by 10% annual net lending growth. And we're going to deliver that with lower sub 1% cost of risk. And finally, with the exit of vehicle finance, the business is now well capitalised, and we're planning to use some of that capital to buy back our own shares over the course of the next 12 months. We've structured the day in order to take you through exactly those points. Firstly, Rachel and I are going to talk about 2025 and some of the goals that we've kicked across the course of that year. Then we'll give you all a cup of tea. And then we're going to focus on what it is we're going to do moving forward. Ultimately, what's the strategy that the business is going to be pursuing, and what are the revised set of medium-term targets that we're going to be chasing down over the course of the next 2 or 3 years. Then we'll hear from our business division heads in terms of how exactly they're translating that strategy into plans in their business lines. And then, of course, there'll be a chance to hear from you in terms of any questions that you've got about the business as we move forward. So that's the structure of the day. Let's focus then on 2025. Well, before I do that, I should give you the small type. The small type is all the numbers that Rachel and I are going to talk about over the course of this presentation are on a continuing basis. Of course, online you'll have all the different numbers, but where we're referring to numbers, unless we tell you otherwise, they are on a continuing basis. Now, in terms of 2025, lots of things went on across the course of the year, and of course, there were some missteps. When I looked at the business outside in before I joined, I sort of looked at it and thought, okay, this is a business with some strong component parts, but that's been really struggling both from a regulatory and an operational perspective to make this motor finance business work. And actually coming into the business, that's very much what I've found. There are some really strong key component parts of this business. We've got genuine specialist knowledge, particularly about the credits and the markets that we're now operating in. Secondly, we've got some strong, flexible IT platforms that we can genuinely use to scale the business. And finally, and critically from my point of view, we've got lots of people across the business who want to do the right thing by both the business and their customers. So there are some fundamental component parts that I think allow us to really build the business as we move forward. My job is to make sure that I bring real strategic clarity, that we refresh the team, and that we focus now on delivery. Delivery without missteps is one of the key things that we're going to be driving towards over the course of this year. But if I look back on 2025, again, some strong numbers have been delivered. Return on average equity in the continuing business at 14.3%. We've simplified the business model with the exit from vehicle finance. That's driving a stronger performance in terms of cost to income ratio. Yes, we need to address some of the stranded costs now that we've got as a result of that exit from vehicle finance, and we'll talk more about our cost programme later on, but a strong result across the course of 2025. And then finally, and this again gives me some confidence as we look forward, we've delivered net lending growth of 8% in both retail and business finance. So we've got a strong platform to continue to grow the business and enhance returns as we march forward. If you look at where the business is now, as I say, it is materially simplified. We've exited vehicle finance, that is now discontinued, and as I say, we've managed to grow both in retail and in business finance across the course of the year, and our deposits business has managed to match that growth as we put assets on year in and year out. So a strong set of performances across our different business lines, and I think a business now that is materially simplified from where it previously was. You can see that coming through in some of the key numbers when we look across the business. NIM very stable at 4.7%. As I say, an improved cost to income outcome in terms of 45.2%. Yes, we need to address some of those stranded costs, but the numbers look strong when you look through the lens of the different KPIs in the business. So as a result of all of that, I'm really pleased that we were able to announce an enhanced dividend at 35.5p, a 5% increase year on year. So some strong numbers that have been coming through the business, and that is ultimately what we should expect to see as we move forward. When you look through this historical lens, you can see that the business has been building momentum year on year. We've continued to grow balances with stable margins, with strong operational efficiency starting to come through. That's driving return on average equity, and in turn, obviously really pleased to see capital accretion across the course of 2025. So the business is materially simplified. It's kicked some goals in 2025. That's building on some of the strength that the business has been focused on over the course of the last few years. So now is the right time for us to start to address where do we go moving forward. And obviously this afternoon what we'll do is to reset some tighter medium-term goals so that we can give you clarity on where it is we're looking to take the business. On that note, I'm going to hand over to give you a little bit more detail on 2025 to our fantastic CFO, Rachel Lawrence.
Thank you. Just going to get a glass of water quickly. Okay, good afternoon, everyone. I'm Rachel Lawrence, and I've been the CFO at STB for over 5 years now, and I've close to 20 years' experience in fast-growing banks. So I will now guide you through the 2025 annual results in greater detail. All the figures, as Ian's just mentioned, I'm going to mention are continuing operations unless I specify otherwise. So, firstly, that was me. Firstly, our return on average equity stood at 14.3% compared to 15% in 2024. This result remains comfortably within our mid-teen ROAE ambition and reflects our ongoing commitment to delivering value to shareholders. Profit before tax was 59.3 million, largely unchanged from 59.4 million in the previous year. However, this figure was impacted by some non-reoccurring operating expenses and a small increase in impairment charges during the period. In terms of income, operating income rose by 6.2% to 165.2 million, up from 155 million in 2024. This growth was underpinned by a 9.5% increase in our average net lending book, which contributed to a 10.1% rise in net interest income. This strong performance was partially offset by a reduction in net fee income from our commercial finance division. We continue to drive operational efficiency, resulting in a 120 basis point improvement in our cost-income ratio to 45.2%, down from 46.4% last year. While operating expenses did increase by 3.5%, this was entirely due to non-recurring costs associated with the changes in our senior leadership team. The underlying growth in the cost base from business volume and inflation was effectively mitigated by these operational efficiencies that we delivered. Cost of risk increased by 20 basis points to 1%, with the impairment charges rising by 8.2 million to 31.4 million. In retail finance, the impairment charges did normalise following one-off model benefits that were in 2024, and there were a small increase in a number of cases within business finance. Turning to discontinued operations, we saw a significant reduction in the loss before tax pre-exceptional costs, driven by lower impairment charges from the vehicle finance business. However, this was offset by the additional provision we took in 25 for the motor finance redress. And finally, from a statutory perspective, the PBT was 27.5 million compared with 29.2 in 2024. So let me just walk through our net interest margin performance in a bit more detail. So overall, net interest margin remained stable at 4.7%. This demonstrates the effectiveness of our cost of funds management and our disciplined approach to asset pricing. So within retail finance, NIM increased by 10 basis points, and this uplift was primarily driven by the contractual repricing lag, whereas the yield curve declined over that period. But in contrast, the real estate finance business saw a decrease of 20 basis points, and this is due to a greater proportion of our low-risk residential investment lending, which has moved from 88.1% of the mix to 92.4%. And lastly, turning to commercial finance, there was a small decrease in net interest margin of 10 basis points, and this stemmed principally from a timing lag in lowering the portfolio cost of funds as UK base rates moved down from its peak in 2024. Lastly, but very importantly, our cost of funds fell by 0.8 percentage points to 4.7%, down from 5.5% in the previous year, with an exit rate of 4.5%. Now on to operating expenses and cost-income ratio. Lending growth has been a key driver for the year, increasing our operating income by 6.2%. On the other hand, our cost base has grown at a slower rate of 3.5%, reflecting inflationary pressures and operating expenses, as well as the higher national insurance contributions. Despite all of these headwinds, we have managed to offset the annual operating cost growth through the successful delivery of efficiencies. You've heard before Project Fusion. I'm pleased to announce that we've completed that, and the efficiencies that we achieved in our continuing business from that this year resulted in a 90 basis points reduction in the cost-income ratio. It is important to highlight, however, that there was £2.5 million of costs which we classify as non-recurring, which were due to changes in the senior leadership team, Without these non-recurring costs, we would have seen a much lower cost-income ratio because they've contributed about 150 basis points of that. So excluding those, the cost-income ratio would have stood at 43.7%. Just looking briefly at the jaws, so excluding the non-recurring costs, we saw an impressive improvement of 6.2 percentage points, demonstrating our focus on cost discipline and operational efficiency. Overall, these results underscore the progress we've made controlling costs while continuing to drive income, positioning us very well for the future. Now let me take you through our cost of risk performance for 2025. We saw a modest rise in our overall cost of risk, reaching 1% compared to 0.8% in 2024. This reflects our ongoing commitment to prudent risk management across our portfolio. Looking at the divisions, within retail finance, the cost of risk increased to 1.4%, up from 1%, but it is worthwhile noting that this uplift was mainly due to non-recurring model enhancements in 2024 that totalled 2.6 million. So if you exclude those, the cost of risk would have been 1.2%, demonstrating a much more modest increase year on year. In real estate finance, the cost of risk rose to 0.6% compared to 0.3% in the prior year. This was principally driven by two cases, including a legacy issue which is now materially resolved. Commercial finance, we saw a notable improvement with the cost of risk declining to 0.9% from 1.7% last year. The prior year figure was affected by a significant loss on a single client. Our overall coverage ratio remains steady at 1.4%, unchanged from 2024, and overall the impairment provisions increased by 2.1 million, driven by 13.9 million relating to new business written and an additional 2.5 million of management overlays. These overlays are applied to ensure our provisions are accurately reflecting the current risks in the portfolio. We've experienced minimal changes in macroeconomic scenarios this year. So overall, these results reflect our disciplined approach to credit risk management and demonstrating our ongoing efforts to accurately provision against current and emerging risks within our portfolio. Moving on, I'll give you a bit of an update, which probably most of you are already aware of, on the 2025 developments on motor finance commission redress. So in October 25, the FCA published a consultation paper outlining its proposed motor finance redress scheme for customers that they had considered have been treated unfairly. This proposal is obviously subject to consultation, and we expect the FCA to come back to us by the end of March with an update on what that policy will look like. But in anticipation of the scheme, the bank recognised an additional provision of 16.4 million to cover the potential customer redress and associated cost. So this figure was based on updating our range of probability-weighted scenarios with a high likelihood of the FCA scheme being implemented as it was originally proposed. We've already updated that if it was proposed exactly as the FCA scheme, it would cost us a further 6 million. Following the sale of consumer vehicle finance business, we will retain the responsibility for any payments due under the redress scheme for the relevant loans once the scheme is finalised and the criteria is confirmed. So we obviously are closely monitoring the situation. We'll keep all stakeholders updated as the consultation process and further details emerge. Right, moving on to the balance sheet. Our cash balances have increased year on year, which largely reflects a £45 million cash deposit we received from the sale of the consumer vehicle finance business at the end of December. And that sale has now successfully completed as of the 25th of February this year. Our continuing loans and advances to customers saw an increase of 8.1%, with growth primarily driven from retail finance and real estate finance. And also our discontinued loans and advances have reduced as the VF PUC continued to wind down after we decided to cease lending in that business. Deposits from customers have grown by 8.2%, supporting the expansion in the lending book. On the other hand, the wholesale funding decreased by 43.9%, which is fully attributable to the early repayment of TFSME. Importantly, shareholders' equity increased by 3.8%, reaching 374.3 million, and the tangible book per share rose by 5.8% to just shy of £20. Let's now just turn to loans and advances to customers. As you can see in this slide, our total loans and advances have increased to 3.3 billion, up from 3.1 billion in 2024. This represents a solid growth of 8.1% in the year, underlying the continued momentum in our lending activities. When we break down this growth by business line, retail finance delivered an impressive 8% increase, with particularly good, strong gains in the furniture sector. Real estate finance saw an even stronger growth at 9.4%, driven predominantly by further expansion into residential investment lending. Commercial finance also contributed positively with a 3.2% increase, which largely reflects the volume of new facilities written and drawn during the year. Looking at our lending mix, the overall portfolio is gradually shifting towards business finance. At the end of 25, business finance now represents 56% of our total lending portfolio, compared to 55% in the prior year, while consumer finance accounts for 44%, slightly down from 46% in the previous period. Turning now to our capital position for 25, we've seen continued capital accretion over the year. Our CET1 ratio increased by 60 basis points, reaching 12.9%. This improvement reflects our ongoing efforts to strengthen our balance sheet while supporting growth in our lending portfolio. So if we take a closer look at the drivers of this capital progression, the capital required to fund our lending growth was comfortably met by reductions in RWAs, largely driven to the run-off of vehicle finance and by retained profits following the deduction of some exceptional items. These factors have all contributed to the uplift in our capital ratios. Those exceptional items actually totaled 24.1 million, which were all exclusively related to vehicle finance. The sale of that vehicle finance business has released additional capital, further improving our CET1 ratio on a pro forma basis to an impressive 14.7%. In line with our progressive dividend policy, we are proposing a full-year dividend of 35.5 pence per share. Our robust capital headroom above minimum regulatory requirements provides us with the flexibility needed to support future growth initiatives. Overall, our capital position remains strong, underpinned by disciplined management and the strategic actions that we took during the year. The combination of improved capital ratios, healthy capital headroom, and consistent dividend policy positions us well for sustainable growth in the periods ahead. Next, on to funding and liquidity. We continue to increase our funding at low cost, which has been instrumental in supporting the growth of our lending book. So customer deposits grew by 8.2% compared to 2024, reaching 3.5 billion. This growth in deposits has not only supported our lending expansion, but importantly, deposits remained stable compared to the first half of 2025, as a deliberate reduction of our vehicle finance book lessened the need for any additional funding. During the year, we secured 1.8 billion in new funding. But it is worthwhile to note that over 59% of that funding is due to mature in the next year. This gives us both increased sensitivity to changes in cost of funds, but also allows us to remain agile and respond to the market. In terms of deposit security, the FS, the Financial Services Compensation Scheme, now covers over 97% of our total deposits, offering significant protection to our customers. Additionally, we've also increased our funding in sale and repurchase arrangements to just over 200 million, up from 125 million in 2024. From a liquidity perspective, our liquid assets consist of balances held with the Bank of England, cash and gilts. Our regulatory metrics remain very strong, with an average liquidity coverage ratio of over 190%, well above the regulatory minimums. This ensures we maintain a prudent liquidity buffer as we grow. So if we break down our customer deposits a bit, total fixed term deposits now account for 77% of the total, up from 73% last year, and notice and access deposits make up the remainder. Overall, our disciplined approach to funding and liquidity management provides a solid foundation for continued sustainable growth as we move forward. Let's now review our segmental financial performance for 25. Starting with retail finance, we saw an increase in income driven by higher balances, lower costs offset by higher impairment charges, all contributing to a strong uplift in PBT of 57.7 million. Turning to real estate finance, we experienced an increase in lending within lower margin, lower risk residential investment segments. Impairment charges rose, but this was mainly due to the two specific cases, with the majority of the impact relating to those legacy cases materially now being resolved. In commercial finance, we observed lower fee income, reflecting a reduction in early termination fees compared to the previous year. But on a positive note, the impairment charges improved relative to 2024, demonstrating our continued focus on prudent risk management. Finally, underlying operating expenses remained broadly flat after adjusting for the one-off costs linked to the changes in leadership. Our segmental performance demonstrates our ability to manage risk, control costs, and deliver sustainable growth across our lending portfolio. Okay, so let's now turn to the strategic decision made regarding the vehicle finance business and the resulting impact that had on the financial performance and the future direction of our business. So, as you know, in July 25, we made the significant decision to stop originating new loans within our vehicle finance business. We placed the existing book into run-off and moved fully aligned with our strategy to focus on the most profitable and higher returning segments of our business. The rationale behind this was clear: to improve our return on average equity and unlock capital that can be better deployed into our continuing businesses, supporting a more sustainable and attractive returns for our shareholders. To reinforce this strategy, I'm pleased to confirm that the sale of the consumer vehicle finance business was completed on the 25th of February, and this transaction accelerates our exit from vehicle finance, generates immediate value, and unlocks additional capital for reinvestment. The consideration received was 458.6 million, resulting in a net gain on sale of approximately 9 million, which will be recognised in our 2026 results. As I mentioned, on a pro forma basis, this boosts our CET1 capital ratio by 180 basis points to 14.7, further enhancing our financial strength and flexibility. Operationally, the exit from vehicle finance is expected to deliver a reduction of 25 million in annualised costs by 2028, with further details to be provided in our investor update later this afternoon. These decisive actions on vehicle finance have strengthened our capital position, improved cost efficiency, and positioned us to deliver better returns going forward. We remain committed to disciplined growth in our core businesses and to maximise value for our shareholders. So, in summary, we've delivered resilient results in 2025, demonstrating strong cost control, prudent risk management, and strategic progress in reshaping our business for sustainable future growth. Thank you for your attention. I will now pass back to Ian, who's going to talk a little bit about the strategic review and outlook.
Thanks, Rachel. I love these things. Fantastic. So just to briefly recap in terms of 2025, relative in particular to the strategy that the business was trying to pursue. We have materially simplified the business. Obviously, we've already talked about the exit of vehicle finance. I'm really hopeful, and the FCA have now said to us they're going to do this by the end of the month, that when we get the final rules, we can move on, get whatever's in front of us out the way and draw a line under vehicle finance from a secure trust bank perspective. Secondly, Project Fusion, I think, points to what we can deliver from a cost point of view. That 8 million has been delivered, and that programme has been closed. And finally, we are now operating as one group. The business is one unit. It's got, as I say, two lending divisions and its deposit business. So we've materially simplified the group as we move forward. We've also made some significant enhancements from a customer point of view. 90% of our retail applications are now auto decisions in 6 seconds. And I think that when you look across the business, our approach of combining both a digital and a relationship-led approach is really making a difference. So those sort of enhancements from a customer point of view are some of the things that have underpinned the, I think, impressive growth that the business has delivered over 2025. 8% growth both in retail and in business finance has been driven by record volumes in both of those divisions. And finally, I think you can see where our tech platform could take us. We've already got, I'm pleased to say, 500,000 people today registered for the V12 app. I think that's only going in one direction. The launch of our new savings app has also enabled us to deliver additional functionality to those customers. And as I say, I think we've got some strong, flexible platforms that we intend to use much more powerfully as we go forward. So 2025, it hasn't been without its missteps, but I think we finished that year in a much stronger position as a business, and that sets the platform for what we'll be taking you through later on in terms of where we intend to drive the business in 2026 and beyond. On that note, I'm going to close the 2025 section, but really keen to get any of your questions or thoughts in terms of the performance during the year. Rachel, do you want to come and join me just to... So happy to take any questions that we've got in the room, and then obviously we'll go to online. Gary, there's a mic coming around to you.
Hi, thanks. It's Gary at Shore Capital. I just wanted to ask about deposit markets and competition in deposit markets. I think we heard from OSB recently that they'd seen a bit more competition. I've heard from Shawbrook this morning that they haven't seen an increase in competition. So just interested as to what your view is on deposit market competition at the moment and how you're positioned.
Sure. So I'm actually pleased we've got Rajat Mehta here, our savings director. So Rajat, you can come up in a second and comment on this. But look, from our point of view, and I think it's one of the powerful things about this business, we've very much been able to be in lockstep in terms of our deposit raising relative to the growth of the business. And actually, whilst of course there are ups and downs in that market, we haven't seen it materially shift. Ultimately, obviously the savings ratio in the UK is going in the right direction. There's a strong set of liquid assets available to us, and I guess our spread across that market has enabled us to maintain that stream without material impacts on the margin. But I don't know, Rajat, if you want to add anything to that.
No, I think I think just echoing what Ian said, I think it's been quite stable for us, and we believe that we can continue to sort of effectively fund our lending ambitions, and in fact continuing to optimize our cost of funds. So actually no real sort of difference, or if anything, efficiencies to be built in.
Hi, Alberto Chalita, 8 Wonder Holdings. I have another questions on the deposits. When I look at 2025, most of the growth in deposits came from ISAs, and with the change in regulation where the limit is moving on the cash ISAs moving down to 12,000, how should we think of that going forward? How should we think of the growth of the ISA deposits?
Again, I'll get Rajat's comment in a second, but I guess from a sort of headline point of view, we don't expect a material impact. Firstly, that's not coming in until 2027. But secondly, ultimately it depends what you expect to happen. I don't expect all of those cash deposits to flow directly into shares. I suspect a large chunk of them will continue to be spread across the deposit market, but just in less tax efficient vehicles. So we still think there's going to be strong availability for us. But Rajat.
Yeah, I mean, I think if you look at our market share in the deposit market of 2.1 trillion market is 0.17%. So we see a very large headroom to continue to grow. If you also look at the ISA market over the last many years, the cash ISA market has actually grown at a much faster clip than any of the other deposit sort of segments. So that growth may sort of curtail a bit, but our customers are essentially the higher value sort of customers we're talking about. It, our average balance per customer is 41,000. So essentially, these are relationships that we've held for a period of time, and we don't actually see a material impact of this on our ability to raise new deposits. We will continue to add new products, and I think we're very well diversified on our ambitions on savings. So we'll have to see how it sort of evolves out, but I don't think it impacts banks of our size. If anything, there is enough headroom for growth in the future.
Phil, have we got questions online that you want to tell us about?
So we have got questions online, but they do relate to the future strategy. So the proposal is to save those for the second session. Ian.
Okay. All right. Well, unless there's other questions that people want to put in the room, then maybe we'll pause there. We'll have a slightly longer cup of tea, and we'll come back for 2:15, where obviously we'll be talking about 2026 and beyond. Thank you very much.